Have you ever wondered whether it's more convenient to pay your brand new car in cash or to take a personal loan? Let's find out together. Hi and welcome back to the channel. In this video I'm gonna present you one of the fundamental rules in finance which will provide you with a magic wand to take more rational financial decisions in your daily life and build the foundation for investing in the stock market. There is one fundamental rule in finance which is overlooked most of the time and which is causing a lot of people to waste money and to take bad financial decisions. In this video I'm gonna break it down for you. Also, make sure you stick around till the end of this video because I'm also sharing a very simple framework which will allow you to take more rational financial decisions next time you buy a smartphone, a car or whatever. So let's get started. The fundamental rule I'm talking about is called the time value of money. And you can master it if you remember these 5 easy points. So point number 1, the present value or PV in short. It is the current value of a future stream of cash flow given a specific interest rate, which is called discount rate, and which is used to move money from the future time to the present. The entire process is called discounting. Point number 2, the future value, or FV in short, is the future value of a current cash flow or asset given a specific interest rate, which is called the rate of return, and which is used to move money from the present to a future date. The entire process is called capitalization. Point number 3, the simple compounding. Future value and present value moves together, as when one of the two increases, the other has to increase as well. In fact, the fundamental relationship between the future value and the present value states that because of the passage of the time, the same exact amount of money today has to be worth more than that same amount of money in the future. An example can best illustrate the link between the two. So let's assume we have John who has received $1,000 today. Since John is a rational investor and doesn't have any mortgage or personal loan, he can decide to go to his bank and deposit the amount for 1 year, earning an interest rate of 10%. After 1 year, John will have $1,100, which represent the future value of $1,000 today. Therefore, $1,000 received now and invested at a 10% interest rate for a 1 year time and $1,100 received in 1 year must have exactly the same value for a person that expected that very same interest rate of 10%. We can therefore then represent the future value as the sum of present value and interest, and since interest is given by the product of present value, interest rate and times, we can substitute and obtain that the future value is equal to the present value times 1 plus the interest rate times the time, which is called the simple compounding. The periodic compounding. But what does it happen if John, who applies financial principle to his everyday life, realizes that he can make use of the $100 he earned in interest and add them back to the initial capital? At the beginning of year 2, John decides to go back to his bank and repeat the same scheme. So if now he decides to reinvest the $1,100 he got at the end of year 1 for additional 2 years, how much does it make in total at the end of year 3, assuming that the same condition still prevails? So let's find out. At the end of year 1, John will make $100 in interest. Year 2, $110, year 3, $121. This is possible because John at the end of each period decides to reinvest both the capital as well as the interest. By looking at the general formula, by substituting, we obtain that the future value is equal to the present value times 1 plus the interest rate to the power of time, which is called the periodic compounding. So in a nutshell, while the interest earned on the simple compounding stays the same, the interest earned on the periodic compounding keeps on growing because every time the interest accrued is added back to the capital of the previous period. And this allows to generate more interest, which are every period greater than the previous one. Point number 5, the compounding frequency. But how can we compare interest rates or rate of return that relates to different periods? So far, we have worked under the assumption that our interest rate was compounded on an annual basis. But interest rates might be compounded at semi-annual, quarterly, monthly, or even weekly frequency. This is just basically telling you how many times the stated nominal interest rate is compounded. We can again ask John to help us with another example. In the previous one, John earned a total interest of $331 after 3 years. Now let's calculate the interest for the same annual rate of 10% for the same maturity 3 years, but assuming a monthly compounding. In order to do that, we need to divide the nominal rate by the number of periods, 12, and to multiply the number of years by the same number of periods. So in the end, the higher the compounding frequency, the higher the interest that John will generate on the initial capital. This very simple rule has a terrific number of applications, which are ignored by most of the people. So for instance, it is used to understand whether the price of a bond or a stock is cheap or not, to better realize the interest that you are earning on your deposit account, or to calculate the monthly installment on your loans. So early in this video, I said I'm gonna share with you a simple framework which would allow you to take more rational financial decisions in your daily life. So now the time has come. So John is super excited because he's about to buy a brand new Tesla Model 3. John lives in US and after having checked the price of the car, which comes at $40,000, he's unsure whether to pay cash with the money he has in a bank account or to take a personal loan from the bank, which comes at 7% interest rate for a 4-year maturity. John, who has been following the Stoic Investor since a while, can now easily calculate how much money he would have to pay back to the bank in terms of capital and interests. By doing so, he can invest the money he has in a bank account for the same duration of the personal loan. John then checks the Wall Street Journal and finds out that a comparable yield on a 4-year treasury is about 4.4%. So, John, by comparing the two alternatives, can quickly see that the interest expenses on the loan would be $52,432, whereas the interest earned on the treasury bond just $37,518. Therefore, he decides to pay cash to Tesla and rather say the interest expenses he would have had to pay to the bank. Congratulations for having completed this video and mastered the time value of money. If you want to know more on how to apply this rule to your stock selection, portfolio construction and personal finance decision, then make sure you keep on following the Stoic Investor by giving a thumbs up, subscribing to the channel and checking the material in the description below. Also, if you want to know more on how we can build on this very simple rule to consistently increase your investment return, then check the videos that are linked in the screen and I see you in there.